Burn, baby, burn. Burn, baby, burn. Burn, baby, burn.
For most people, the entry price for artificial intelligence is a subscription fee of about $20 a month. This flat rate suggests a stable, mature product that is ready for the mass market. However, every prompt triggers a process called inference, which consumes vast amounts of electricity and wears down expensive hardware. Current estimates of these operating costs suggest that to break even, companies would need to charge users 10 to 25 times their current subscription fees. For a regular user, that hidden deficit can accumulate into thousands of dollars of unpaid computing costs in a single year. This chart frames the problem at an industrial scale. This bar represents the $600 billion the tech sector is spending on AI infrastructure, while the smaller bar shows actual revenue. The result is a massive annual hole in the industry's balance sheet. These losses are hitting the most prominent names in the field. Companies like OpenAI and Anthropic are currently burning billions of dollars on compute power alone to keep their systems running for the public. To bridge a gap of this size, a company must eventually choose to either significantly increase prices or find a way to make computing vastly cheaper. Currently, prices are staying low to attract users, while the cost of high-end hardware continues to climb. The foundational math of the AI economy is currently broken. Since the user isn't paying for the full cost of the service, a massive, invisible pool of capital must be subsidizing the difference to keep the technology accessible. This subsidized model depends on a massive physical footprint. To function, AI requires gigawatt-scale data centers, physical warehouses packed with thousands of high-end graphics processing units, or GPUs, that handle the heavy mathematical lifting. These facilities are running into a physical bottleneck. Regional power grids were not designed for this level of demand, and many areas simply cannot provide the electricity required to turn these new data centers on. Tech giants are attempting to bypass the grid by securing their own power sources. Microsoft recently signed a deal to revive the shuttered 3 Mile Island nuclear reactor, hoping to lock in the energy it needs for future operations. But infrastructure on this scale takes years to build. This leaves companies with billions in hardware sitting in idle data centers that cannot run, even as they continue to pay interest on the money they borrowed to build them. Because these facilities aren't generating enough revenue to pay for their own construction, tech companies are forced to go back to the debt markets to keep their projects alive. Wall Street has stepped in to bridge this gap, issuing hundreds of billions of dollars in corporate loans specifically to fund the AI build-out. To manage massive loan risks, banks use special purpose vehicles. These entities bundle tech debt into a single container, obscuring total liability. The SPVs are then sliced into smaller, marketable bonds, asset-backed securities, allowing banks to sell the debt to outside investors. The primary buyers of these securities are large institutional investors. These entities manage the collective savings found in ordinary 401ks and municipal pension funds. The cash keeping the AI industry afloat is ultimately coming from the retirement savings of the general public. This mechanism of bundling high-risk, unprofitable debt and selling it to the public mimics the same structures that led to the 2008 global financial crisis. In this version of the cycle, the underlying assets aren't houses, but data centers full of hardware that loses value every month it sits idle. By utilizing private fundraising rounds, executives can lock in personal wealth and massive company valuations while they are still losing money. Because the debt has been packaged and sold to bondholders, the leadership is often shielded from the financial fallout if those loans are never repaid. Some analysts believe the industry is positioning itself to be too big to fail, assuming the government will be forced to provide bailouts to prevent infrastructure collapse. A crash in the AI sector would flow directly into institutional funds holding these assets, potentially draining the pension funds and retirement accounts of people who never used the technology. The current trajectory of the AI industry relies on an engineered wealth transfer that leaves the public holding the financial risk for an unproven technological revolution.
Burn, baby, burn. Burn, baby, burn. Burn, baby, burn.